When it comes to guiding a country's economy, not all policies are created equal, and confusing fiscal and monetary policy can leave anyone scratching their head. So what's the difference, and why should you care? In this video, we'll break down fiscal policy, how governments spend and tax, and monetary policy, how central banks control money and interest rates, in clear, simple terms. You'll see how each affects inflation, jobs, borrowing, and your everyday finances. Today, we will talk about fiscal versus monetary policy. Key differences explained. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is fiscal policy? Fiscal policy refers to the government's use of spending and taxation to influence the economy. When a government wants to stimulate growth, it may increase spending on infrastructure, education, or healthcare, or reduce taxes to boost disposable income for households. Conversely, during inflationary periods, the government may cut spending or raise taxes to slow down excessive demand. Fiscal policy decisions are made by elected officials, such as finance ministers or parliaments, rather than central banks. It directly impacts public services, employment, and income distribution. The main goal of fiscal policy is to maintain economic stability, encourage growth, and reduce unemployment. By adjusting how much money the government collects and spends, fiscal policy can boost or slow economic activity. Unlike monetary policy, fiscal policy works through changes in actual government budgets and affects citizens more directly. Understanding fiscal policy helps individuals grasp why governments introduce tax cuts, stimulus packages, or public projects, and how these measures influence everyday financial decisions. 2. What is monetary policy? Monetary policy is the process by which a central bank controls the money supply and interest rates to stabilize the economy. Central banks, like the Federal Reserve or the European Central Bank, use monetary policy to manage inflation, encourage investment, and maintain employment levels. Monetary policy operates indirectly by influencing borrowing, lending, and saving behavior. For example, lowering interest rates makes loans cheaper, encouraging businesses and consumers to spend, while raising rates discourages borrowing and slows down inflation. Unlike fiscal policy, monetary policy does not involve government budgets or taxation. It works through banking and financial systems. Central banks also use tools such as reserve requirements, open market operations, and quantitative easing to regulate liquidity in the economy. Understanding monetary policy helps individuals and businesses anticipate changes in loan rates, investment opportunities, and market conditions. While fiscal policy is government-driven, monetary policy is implemented by central banks, creating complementary mechanisms to manage the economy. 3. Main goals of fiscal policy. Fiscal policy primarily focuses on stabilizing the economy, reducing unemployment, and promoting economic growth. Governments use fiscal tools to influence aggregate demand, spending by households, businesses, and the public sector. During recessions, expansionary fiscal policy, such as increased government spending or tax reductions, encourages consumption and investment. During periods of high inflation, contractionary fiscal policy, like spending cuts or tax hikes, reduces demand and cools the economy. Fiscal policy also addresses social objectives, such as reducing income inequality, funding education, and supporting public health. By adjusting budgets and tax policies, governments can influence both short-term economic activity and long-term development. Fiscal policy decisions are often politically debated because they directly affect citizens' lives. Understanding its goals helps people see why governments prioritize certain programs or introduce stimulus packages, and how these measures impact household finances, businesses, and the overall economy. 4. Main goals of monetary policy. The primary goal of monetary policy is to maintain price stability while supporting sustainable economic growth. Central banks aim to control inflation, encourage employment, and stabilize financial markets. By adjusting interest rates, managing money supply, and using tools like reserve requirements, central banks influence the cost and availability of credit. For instance, lower interest rates stimulate borrowing and spending, boosting economic activity. Higher rates slow borrowing to control inflation. Monetary policy decisions are typically independent of political pressures to maintain credibility and long-term stability. Another goal is to stabilize currency value, which affects imports, exports, and international investment. Understanding these goals helps individuals, businesses, and investors predict changes in borrowing costs, savings returns, and market conditions. Monetary policy ensures that the economy grows steadily without overheating or spiraling into deflation or inflation crises. 5. Tools of fiscal policy. Fiscal policy relies mainly on two tools: government spending and taxation. Spending can include infrastructure projects, subsidies, defense, healthcare, and social welfare programs. Increasing spending injects money into the economy, boosting consumption and demand. Taxation influences disposable income. Tax cuts increase household spending, while tax hikes reduce demand to control inflation. Governments may also use targeted policies such as unemployment benefits or investment incentives to stimulate specific sectors. Fiscal tools are direct because they involve actual government transactions in the economy. The effectiveness of these tools depends on timing, scale, and how quickly money reaches the public. Understanding these mechanisms helps citizens see how government budgets and policies affect daily life, job opportunities, and overall economic activity. 6. Tools of monetary policy. Monetary policy uses tools like interest rate adjustments, open market operations, reserve requirements, and quantitative easing. Interest rates influence borrowing and saving behavior. Open market operations involve buying or selling government bonds to increase or reduce money in circulation. Reserve requirements dictate how much banks must hold in reserve, affecting lending capacity. Quantitative easing injects large amounts of liquidity into the economy, often used during severe recessions. Unlike fiscal policy, monetary policy works indirectly but affects the entire financial system. Central banks use these tools to stabilize prices, promote growth, and maintain financial stability. Understanding monetary tools helps individuals anticipate changes in loan rates, investment yields, and economic activity. 7. Differences in implementation. Fiscal policy is implemented by elected government officials, such as finance ministries or parliaments, and involves budgetary decisions like spending and taxation. Monetary policy is controlled by independent central banks and uses financial mechanisms to influence the economy indirectly. Fiscal policy often faces political debates and election cycles, which can affect decision-making. Monetary policy decisions are typically insulated from political pressures to maintain credibility. 8. Impact on the economy. Both fiscal and monetary policies aim to stabilize the economy, but their effects differ. Fiscal policy directly injects or withdraws money from the economy, affecting demand and employment almost immediately. Monetary policy influences economic behavior indirectly through interest rates, credit availability, and expectations. During a recession, fiscal stimulus may provide immediate relief through government spending, while monetary policy encourages borrowing and investment. Inflation control often relies more heavily on monetary policy because it directly affects the cost of money. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.